Assalamualaikum warahmatullah and welcome to part 2 of the Insolvency and Restructuring series. In this video presentation, we will continue with discussing business valuation and some valuation methods. Specifically, we will be talking about why businesses need to be valued, who would do the valuation, and how we do the valuation. We will also discuss few examples of the valuation methods. To start with the discussion on business valuation, let us ask this question first. Why do we do business valuation? Is it only when we want to sell that we need to do valuations for our businesses? Not quite. Tanya Tiltman from consolidate.com.au in association with BDO gives 8 reasons why we need to know the value of our businesses. She presented these questions, and if your answer to any of these questions is yes, you should consider valuing your businesses. These are some of the reasons why we do business valuation, not only us as business owners, but also us as potential investors. These include, for example, plan to grow. We do business valuation to know the current value of our business as a starting point and plan the benchmark for growth. The valuation reports also present the identified areas for improvement and the sources of negative impact to our business. From here, we could develop strategies to curb the problem, increase growth, and improve the value of our business. Similarly, if we plan an exit strategy, we need to have some idea to set a baseline value for our business. Annual business valuation could be, again, a starting point for the planning process. From there, we could develop a strategy to improve the profitability, for example, to increase the value to a point we desire at the time of exit. This solution is also a common reason for business valuation. This could be due to disputes among shareholders or partners, or simply us achieving the objective of the business venture and decided to dissolve it as we no longer need it. For this, knowing the value could be beneficial for the legal proceeding. Other common reasons include mergers and acquisition and determining the annual per share value for Employee Share Ownership Plan or ESOP. Bottom line, whatever pushes you to know the value of your business now, that will be the reason for doing business valuation, including marital dissolution. For the questions of who does the business valuation, it all depends on the purpose. For example, if the purpose is for selling, most likely the one doing the valuation would be the owner of the business or an investment banker or a professional advisor to business owner or investment banks. If the purpose is to assess potential investment, the valuation would be done by someone like professional investors, strategic investors, and financial or business analysts. When it comes to the questions of how we do business valuation, it is always about approaches and methods. But before we even discuss the approaches and methods, we first need to determine one thing. Is the business enterprise or the company in question a viable entity? The viability of a business is measured by its long-term survival and its ability to sustain profits over a period of time. A business is able to survive when it's viable, because it continues to make a profit year after year. The longer a company can stay profitable, the better its viability. If the company in question is determined to be viable, then we can consider going concern approaches. These type of approaches will look at future returns, the market for the company, and will also include valuations of the assets within the company. Market approach basically value the assets of the company by looking at how the market prices similar or comparable assets, and thus based on whatever the market is willing to pay for it. However, at times, This can be deemed difficult, as truly similar companies is quite tricky to find. If the company in question is determined not to be viable, then we should consider liquidation approach. This is where we need to use asset-based methods, and usually it is not a voluntary liquidation. It is useful for loss-making companies with limited prospects of recovery. The logic behind it is, as the company is deemed non-viable, there is no way that we are looking at its future, well, at least before it undergoes any restructuring plans. If we want to know the value of the business now, we can only refer to its current existing assets at its selling price, since we cannot depend on the operations anymore. This is when we consider the worst case scenario. The methodologies that we may use under this approach are the orderly realizations of assets method, the liquidation method, and the net assets on a going concern based method. Just to note, asset-based approach is also suitable for asset-based companies such as banks, holding companies, and manufacturing companies, even when they are viable. Another interesting point to highlight is which calculation engagement that a business need. This question is posted by Liz Farr, a CPA from firmofthefuture.com. Interestingly, business valuation can be approached in two ways, valuation or calculation. One of these is more complex and expensive, while the other is simpler and cheaper. Business valuation usually involves a lengthy report that will include an opinion of the estimated value of the business, plus the analysis, calculations, and background information the analyst relied upon to reach that conclusion. Not only that the valuation needs to consider the financial and non-financial attributes of the business, the analyst will also consider the overall economy, current and future industry trends, and the likelihood of long-term success for the business. In other words, it conveys the highest level of assurance, and it is useful if it involves litigation or in need to stand up to the IRB scrutiny. And in short, if the appraisal needs to stand up in court or will be filed as support for a tax return, you will need a business valuation. On the other hand, if the company in question is in a low-risk situation and a friendly handshake type agreement is anticipated, Liz Farr suggested a calculation, as it might serve its needs just fine. Calculation engagements are simpler and take less time, but they don't carry the same level of assurance. It simply is a calculation of value. An analyst, for example, will decide with his or her client on what calculation methods to be used and the extent of those methods. For example, a multiple of the weighted average of gross revenues over the last 5 years might be selected. Most of the detailed analysis with a complete valuation will not be considered. And because only one clearly defined method is used, and because the scope of analysis is limited, the resulting value may be quite different from the value that would result from a business valuation engagement. Therefore, this method is best for planning purposes or friendly negotiations outside of court, such as a succession plan where all parties are in consensus. In categorizing approaches and methods, it varies based on how you look at it and what you should use it for. But basically, the methods categorized within them are the same. If you refer to the Malaysian valuation standards, approaches or methods are categorized into three: comparison approach, income approach, and cost approach. For comparison approach, we can use any relevant financial information such as sales and comparison made between similar companies. There are some strict requirements to be fulfilled when using this. For income approach, this includes investment method, residual method, discounted cash flow method, and profits method. Basically, what we are looking at is the future potential of the business in terms of income, either profits or future cash. And for cost approach, we look at the cost of building, structures, and improvements of assets within the business while taking into consideration depreciation. While for land, the specific requirements are similar to those of comparison approach. But these are the way in which the Malaysian valuation standards categorize it. Others, such as industry practitioners, may categorize the valuation methods into three: DCF analysis, comparable company analysis, and precedent transaction. For DCF analysis or discounted cash flows analysis, it is an analysis of an intrinsic value, where we look into the cash flow in the future and discount it back to today at the firm's weighted average cost of capital, or WACC. This approach requires an extensive amount of details and analysis, therefore claim to produce the highest value and applaud as giving the most accurate valuation, as it allows the analyst to forecast value based on different scenarios in the future. But it also requires a lot of assumptions, as we are talking about the future. For comparable company analysis, which also known as trading multiples, peer group analysis, or equity comps or public market multiples, this analysis is a relative valuation method where we compare the current value of business to other similar businesses by looking at trading multiples like PE ratios and EBITDA, that is earnings before interest, tax, depreciation, and amortization. For precedent transaction, it is also a form of relative valuation, where we compare the company that we are interested in, or our own company, to other businesses that have recently been sold or acquired in the same industry. These transaction values include the takeover premium included in the price for which they were acquired. Basically, values from this approach are useful for M&A transactions, but can easily become stale-dated and no longer reflective of the current market as time passes. There are less commonly used market trading multiples. These two approaches can also be categorized under market-based approach, since both are looking at relative values. While DCF analysis can easily be categorized under income-based approach. However, comparable company analysis can also be categorized under income-based approach, as the ratio used are based on income. And another category that I want to highlight here is asset-based approach, as we mentioned earlier. As you can see, the categorizations of these approaches and methods varies from different perspectives, yet they are all valid and correct. Regardless of the categories, when we do business valuation, these basic principles must be observed. First, the prospective company, that is, what is expected of the company in the future. Second, valuation must be determined at a point in time, thus taking into consideration relevant information at that point in time as the base and might look at the future from what we know at that point in time. And third, valuation usually driven by earnings and cash flows from going concern company and liquidation value for non-viable company. An interesting thing to note is the questions of which value should we use, the price or end value, or the fair market value, or the starting value. Naturally, the next question to ask is which method should we use? Here, just to show you that valuation methods are many, and in this table are just a few of them, which I took from Fernandez 2013, who talks about company valuation method. To give you some idea, let us consider this. Say we have company A and company B, where these two companies have the exact same balance sheet and income statements, but with a different prospect. Company A has a high sales, earnings, and margin potential, while Company B has a stable financial condition with fierce competition. Which of these two would you give a higher value to? Give it a thought before you answer. Yes, we definitely be looking at Company A with high sales, earnings, and margin potentials. Given the information provided, we definitely be looking into the future. Thus, the most suitable method is discounted cash flow, where Company A will definitely result in a higher value. Company B, on the other hand, has a more stable financial condition, but there is no mention about stable income in terms of sales or earnings in the future. Furthermore, we are even given a warning of a fierce competition. Thus, we could imagine how, in a competitive market, you need a competitive advantage to survive, and we are not being informed of that. Fierce competition would give us the idea that margin would probably be small. Here, I just want to share with you another perspective on valuation method. Anthony Wilson of Deloitte shares some of his wisdom on valuation methods, specifically about how easy some methods can be manipulated to get a value that a party might desire. But why anyone would want to do that, you may ask? Well, according to him, we are never independent, meaning our income, that is as a valuer or CPA, that are required to do valuation for clients, our income is dependent on the client, and we always negotiate to get things done. But he's not saying that we can never be honest in our valuation. It's just that we must be careful and must always be suspicious in certain situations. Let's continue with the manipulation. For example, in the DCF method, one can easily manipulate the value from this method by manipulating the discount rate. We can choose a rate that does not reflect risks of cash flows, for example. We can also use different rates for different year of the cash flows as risk changes over time, which is logical, but it all depends on your intention. Or we manipulate the fixed assets investment needs. Or we simply ignore relevant factors such as competition and globalizations in generating future profit margins. Though previously, we have seen that DCF is deemed to be giving the most accurate value. By considering these potential manipulations, Wilson believed that these and many more are the reasons why DCF should be viewed with suspicion. Now, how about market approach, where it depends on market comparison? How could one manipulate the result? Easy. We could carefully select companies that we want to make comparison with that give optimal result. No profits? No worries, just focus on sales or future profits.